F.W. Woolworth built one of the largest retail fortunes in American history. By the time he died in 1919, his stores stretched across the country, and his estate was worth the modern equivalent of hundreds of millions of dollars. Enough to fund his descendants for generations. Enough, in theory, to still be growing today. It isn't. Most of it is gone, spent, scattered, and forgotten by branches of the family most people have never heard of. Here's the question that should bother you. Not, how did that happen to them? But, what if it's already happening to you, and you don't know it yet? Because the truth is, the four things that quietly destroyed that fortune have nothing to do with being rich. They exist in ordinary households, right now, completely unnoticed, doing the exact same damage on a smaller scale. Hi viewers. Before we go further, a simple question. If you had to guess right now, what do you think destroys family money faster than anything else? Taxes, bad luck, or something else entirely? Drop your guess in the comments. You'll find out if you're right in the next few minutes. Most people, when they picture generational wealth disappearing, picture something dramatic. A stock market crash, a lawsuit, a greedy relative, a tax bill big enough to gut an inheritance overnight. It's a satisfying story. It has a villain. It is also, for almost everyone watching this, completely wrong. There's a study, one of the most cited in the entire wealth management industry, built from 20 years of watching over 3,000 wealthy families, and it found something that should genuinely unsettle you. 70% of those families lost their wealth by the second generation. 90% lost it by the third. Not most of it, nearly all of it. Read that again, slowly, because the number that should actually scare you isn't the size of the fortunes that vanished. It's how fast. 2 generations. That's it. That's often all it takes for a lifetime of building to become nothing. And here's the part almost nobody tells you. The families in that study weren't destroyed by the thing you're probably assuming right now. We're going to walk through exactly what killed those fortunes, piece by piece, with the real numbers behind it. Not vague advice, not motivational nonsense. The actual mechanics, the same ones that apply whether you're sitting on $200,000 or $200 million. But first, we need to deal with the story almost everyone believes. The one that lets people feel like this isn't their problem. The one about the government taking half of everything the moment you die. It's the first thing people blame, and it's almost never the real killer. Ask most people why family fortunes disappear, and they'll say taxes. The government takes half when you die, then takes another chunk when your children die, and by the third generation, there's nothing left to give away. It's a clean story. It has a clear villain. It lets you believe none of this applies to you, unless you're already rich. Here's the current law, and it matters more than almost anyone realizes. As of 2026, the federal estate tax exemption is $15 million per person, $30 million for a married couple, and it's now permanent, adjusted upward every year for inflation. Below that line, the federal government doesn't take a reduced share. It takes nothing. Zero. Picture a wall, $15 million high. Almost everyone watching this video could walk straight under it without ever touching the top. Fewer than 2 out of every 1,000 estates in America ever owe a single dollar in federal estate tax. Not 2%, 0.2%. So unless you're planning to leave behind more than $15 million, the tax man was never coming for your family. He was never even in the building. There is one honest exception, and it deserves a moment of your attention. About a dozen states still run their own estate or inheritance tax, and a handful of them start much lower than the federal line, sometimes as low as $1 or $2 million. So depending on your zip code, a smaller state bill can show up decades before the federal one ever would. But even there, the numbers are a fraction of what people fear. A modest state tax bill does not empty a great fortune. It never has. Which leaves us with the real question. If the tax collector isn't the one draining these fortunes, who is? The answer is that wealth rarely dies from one dramatic blow. It bleeds out slowly, through a small number of structural gaps that most families never think to close, because they assume those tools are for someone richer, someone older, someone else. They aren't. And the reason they matter has nothing to do with how much money you're starting with. It comes down to a single number, one almost nobody is ever taught, and once you see it, you'll never look at money the same way again. Picture a bathtub. Water pours in from a faucet. That's what your money earns every year. Water drains out through the bottom. That's what your family spends. As long as the faucet runs faster than the drain, the water level in that tub never falls. It can sit there, full, for 100 years. The moment the drain runs faster than the faucet, something changes. Not slowly, not gently. A countdown begins. And that countdown has a fixed, calculable end date. Here's what that looks like with real numbers. $2 million, earning a steady 5% a year after inflation, produces $100,000 annually without ever touching the original pile. Live on that 100,000, and the tub never empties. It's functionally permanent. Now watch what happens with just a small change. Spend $120,000 instead. Only 20% more than the faucet provides. That same $2 million runs completely dry in 37 years. Less than a single lifetime. Push spending to $150,000 and it's gone in 23. Push it to $200,000, double the sustainable amount, and the entire fortune disappears in 15 years. One generation. Gone. Here's the part that should genuinely surprise you. This works exactly the same way at any size. Take $1 million at that same 5%, and the sustainable line is $50,000 a year. Live on 50, the money lasts forever. Spend 60, just 20% over, and it empties in the exact same 37 years as the $2 million example. The size of the fortune never decided the outcome, only the percentage by which the family overspent the line. A small family crosses that line and feels it within a decade. A massive fortune can absorb the same overspending for most of a century before it finally runs out. But the direction, the ending, is identical. And it comes down to one comparison: what the money earns against what the family spends. Cross that line, and no fortune, no matter how large, survives it. That single sentence is the entire tragedy of generational wealth. And it's exactly what happened to the fortune we opened this video with. They didn't lose it to a tax bill. They lost it because for decades, the drain ran faster than the faucet, and nobody was watching the tub. Everything from here forward exists to answer one question: how do you keep a family on the right side of that line, long after you're no longer around to enforce it? The first system is the one almost everyone gets slightly wrong, so it's worth being precise here. Families who keep their wealth for generations don't hand assets directly to their children as personal property. They place those assets inside a structure, a trust, a holding company, a family entity. The children inherit a relationship to that structure, not a stack of shares with their own name printed on it. Now, there's a myth attached to this, and it needs to die immediately. The myth is that splitting money between multiple heirs is what destroys a fortune, and that keeping everything in one entity is what prevents that. Watch the math, because it tells a different story. $2 million held in a single pool, spent exactly at its limit, and that same $2 million split evenly 3 ways, each heir spending proportionally to their share, hit zero at the exact same moment. The math doesn't care whether the money lives in one account or 3. Splitting the money was never the killer. So why does structure actually matter? 3 real reasons. First, discipline. When 3 heirs each own their piece outright, each one spends according to their own life, their own lifestyle, with nobody watching the combined total. Quietly, their spending drifts above what the whole pool earns, and the countdown starts without a single person ever deciding it should. One structure, with shared rules, forces the family to measure spending against one number, on purpose, instead of drifting past it by accident. Second, access. A large pool of money reaches investment opportunities a small individual share never could. It pays lower fees as a percentage of the whole. It stays properly diversified. Break 2 million into 3 smaller shares, and each individual portion tends to earn less on its own, which shortens the very timeline that was supposed to protect it. Third, protection. Money held personally is exposed to lawsuits, divorces, creditors, one bad decade from one family member. Money held properly inside a structure is insulated from all of it. One person's disaster doesn't reach through and drain the whole family's future. You've actually seen this play out at the largest possible scale, even if you never noticed it. One of the wealthiest retail families in the country doesn't hold its business as individually divided personal shares scattered across relatives. It holds the bulk of it through a single family entity, keeping control concentrated and the fortune intact across generations. The same exact principle works at any size. If the only real asset your family owns is a paid-off house, the question is identical. Does it pass down as personal property to be split and argued over? Or does it pass down inside a structure, with rules already written? Which brings us somewhere most people never think to look. Because owning something and controlling something are not the same thing, and confusing the two is how perfectly good assets get quietly destroyed. Picture a small business with 3 equal partners, each one free to sell their share whenever they want. It feels fair on paper. It's actually a slow-moving disaster waiting to happen. The day one partner sells to a stranger, the other 2 are suddenly in business with someone they never chose. Someone who votes their own way, blocks decisions, or pushes the company somewhere the founders never intended. Worse, because everyone knows that share can be sold, seized, or borrowed against, the entire business quietly becomes a target. A creditor sees something worth taking. A lawsuit sees something worth winning. A divorce sees something worth dividing. Visible, easy liquidity invites every single one of them to the table. The fix isn't making it impossible to sell. Sometimes a family member genuinely needs out, and trapping them creates its own kind of disaster. The fix is making the important moves difficult, never impossible. Transfer restrictions do exactly that. They say a stake can't simply be handed to an outsider on a whim. A right of first refusal says that if someone truly does want to sell, the family gets the first chance to buy them out fairly, before anyone outside the family ever gets the offer. The partner who genuinely needs cash still gets their cash. The stranger with a checkbook never gets through the door. And here's what that quietly solves. The most common reason families are forced to sell a good asset isn't that the asset stopped being valuable, it's that they needed cash, and selling looked like the only way to get it. But cash was never really the problem. Access to cash was the problem. Families with the right structure build that access in deliberately, often by borrowing against what they already own, instead of giving it up, so they never have to sell the very thing that made them wealthy just to solve a short-term need. The third system is the one that would have saved more family fortunes throughout history than almost anything else on this list, and it costs absolutely nothing but the decision to write it down. Picture 2 brothers who inherit a company worth $5 million. No written rules came with it, just shared ownership and good intentions. One brother wants to reinvest the profits and keep growing the business. The other wants his share in cash, now. Neither of them is wrong exactly. They simply want different things, and nothing on paper says how to settle it. Then life happens. A divorce enters the picture. A creditor comes calling, with no rules for how the company handles a member who suddenly needs money, no mechanism for a loan, no clear path to a fair buyout. The only option left is the most extreme one: sell the entire company. And a company sold under pressure, on somebody else's timeline, almost never sells for what it's actually worth. If that forced sale brings in only 60 cents on the dollar, a realistic outcome for a distressed sale, $5 million becomes 3. 40% of everything, gone. Not because the business failed, because there were no rules for a bad moment. That page has a name, a family constitution. Instead of handing heirs raw, unstructured ownership, you hand them assets governed by agreed rules. How a member takes money out, how they can borrow against their share, how someone who genuinely needs to leave gets bought out fairly. And above everything else, a rule that no single person, in a moment of panic or anger, can force the whole thing to be sold. Every system up to this point has been about the money itself. The last one is about the people who inherit it, and it's the one families skip most often, usually to their own ruin. Here's a small heresy worth sitting with. Think twice before paying your kids for chores. It sounds harmless, even responsible, but it quietly teaches a lesson that compounds for decades. That work is the unpleasant thing you endure in order to get paid. That effort and money are simply the same transaction. And a child raised to believe that grows into an heir who sees the family's money as an escape from work, rather than a responsibility to look after. An heir who wants to escape work is exactly the heir who ends up spending past the line. The families who actually keep their wealth do something different. They don't pay for chores. They build the skills that create value in the first place. When a child shows genuine interest in something, anything at all, that interest gets routed into something real. A small project, a tiny business, a first investment made with actual stakes attached. The lesson flips entirely. Money isn't something you're handed. It's something you build by creating value the world genuinely wants. And managing it well is a skill you practice, not a windfall you passively receive. So picture that family from the beginning of this video again. Their fortune, left simply invested and mostly left alone, should have grown into something almost unimaginable by today. Instead, it evaporated within 2 generations, not because of a market crash, not because of a tax collector, because for decades, the drain ran faster than the faucet. No structure held the family's spending together. No rules existed for the hard moments, and no one was ever taught to see any of it coming. Here's what should actually stay with you. None of the 4 systems in this video require $10 million to matter. The line is just as real at 200,000 as it is at 200 million. It's your assets, multiplied by what they actually earn, and it tells you the precise amount your family can spend without ever starting the countdown. That's what generational wealth really is. Not a dynasty, not a private island, not a name people recognize 100 years later. It's a family that knows its number and builds a structure that keeps them under it long after they're no longer around to enforce it. Your line isn't the family we opened this video with. It's yours. And now, unlike almost everyone else who will ever think about this, you actually know how to find it. If this changed the way you think about money, that's exactly what it was built to do. Like this video, share it with someone who needs to hear it, and subscribe for the next one, because there's a deeper question sitting underneath everything we just covered. Why does wealth come so naturally to some people, and stay permanently out of reach for others? That's not luck, and it's not income. It comes down to a small set of laws almost nobody is ever taught. And once you see them, you can't unsee them.